Hey everyone, and welcome back. We're diving deep into currency markets today, focusing on the euro and the US dollar.
Sounds exciting.
It is. We've got some great analysis from finance publications, kind of looking at how things are moving and what might be coming up.
Okay, cool.
So get this, the euro's been doing really well lately, hit its highest point against the dollar since November 2025.
Wow, that's
Yeah,
that's pretty significant.
huge. So is this temporary or the start of a longer trend?
Well, that's the million-dollar question, isn't it?
It is.
The euro has been climbing, but there are signs that this upward momentum might be hitting a ceiling.
Oh, really?
Yeah, last Tuesday, the euro reached 1.0946 against the dollar.
Okay.
But some experts are saying this might be the peak, for now at least.
Okay, so the euro's had a good run, but what's making these experts think the rally might be over? Is there something they're seeing that we're missing?
Well, one indicator they're looking at is the RSI, or Relative Strength Index.
Oh.
Think of it like a thermometer for a currency. Right now, the euro's RSI is above 70, which puts it in overbought territory.
Okay.
This basically means the euro has been rising so quickly that it might be due for a little breather.
So kind of like a stock that's gone up too fast.
Exactly.
It doesn't necessarily mean a crash is coming,
Right.
but it could mean a correction is on the horizon.
Yeah, exactly.
Uh,
But before we dive into the potential risks, let's unpack what's been fueling the euro strength in the first place.
all right, let's hear it. What's been driving the euro's impressive climb?
Well, for one, there's been a shift in market sentiment away from the U.S.
Oh, interesting.
Remember all the talk about U.S. exceptionalism back in 2024?
Yeah.
Well, that narrative seems to be fading due to some policy uncertainty coming out of the White House
Okay.
and concerns about tariffs hurting the U.S. economy.
So it sounds like the markets are saying, hold on, maybe the U.S. isn't the guaranteed winner we thought it was.
That's one way to put it, yeah.
Interesting.
And while the U.S. is dealing with uncertainty, Germany's making some interesting moves that are boosting confidence in the Eurozone.
Okay.
They've announced a pretty unexpected shift toward increased spending on infrastructure and defense.
Wait, Germany's spending more? That's not exactly the reputation, is it?
It's definitely a big deal.
Yeah.
Some analysts are actually quite optimistic about it.
Interesting.
Birgit Hensler, an analyst at DZ Bank, put it this way. The euro is benefiting from higher long-term yields and hopes for massive investment programs. These could help to get the European, and especially the ailing German economy, back on track. After years of misery, this is finally a real glimmer of hope to stand up to the U.S. dollar.
A real glimmer of hope. That's a powerful statement.
It is.
But is everyone convinced that this spending spree will actually work?
Right.
Germany isn't exactly known for splashing the cash, right?
That's a good point.
Yeah.
Not everyone is on board with this optimistic outlook.
Okay.
In fact, analysts at Commerzbank have issued a warning that the euro could actually be headed for a sharp fall in the coming weeks.
Whoa, hold on. A sharp fall. That's a pretty dramatic prediction.
It is.
Why are they so bearish on the euro if Germany is increasing spending?
Yeah.
That seems like a good thing, right?
It does on the surface.
Yeah.
But Commerzbank is arguing that the positive effects of this stimulus might not be felt until next year.
Oh, okay.
Plus, there's no guarantee things will go smoothly.
Right.
They're pointing to Germany's history of struggling to actually spend allocated funds,
Oh.
even when the money is available.
Ah, so it's a wait-and-see situation?
Yeah,
The potential is there, but Germany needs to prove they can actually follow through.
exactly.
Is that the only thing Commerzbank is worried about?
Well, there's another big factor, those U.S. tariffs we mentioned earlier.
Right.
Joachim Igel, the president of the Deutsche Bundesbank, warned that if Trump actually goes ahead with his tariff threats against EU imports, it could push Germany straight back into recession.
Okay, that would definitely change things.
It would.
So we've got this tug of war happening.
Yeah.
On one hand, we have Germany's spending boosts potentially pushing the euro higher. On the other hand, there are those looming tariff threats and doubts about whether Germany can really deliver.
Right.
This is getting complicated.
It is to add to the mix. One Commerzbank analyst, Michael Feister, had this to say. This year, growth in the euro area could even be weaker if Trump follows through on his tariff announcements on EU imports in the near future. In short, we expect the EUR-USD exchange rate to fall quite sharply in the coming weeks.
Wow, he didn't mince words. So we have these competing narratives, and it's hard to say which force will win out.
It is, yeah.
But that's what makes currency markets so fascinating, right? Trying to predict how global events will impact exchange rates.
Exactly. And This week is going to be particularly interesting
Okay.
because there are a few key economic events happening that could influence both the euro and the dollar.
All right.
These events could give us some valuable clues about where things are headed.
Okay, this is getting good.
Yeah.
A real economic showdown is brewing, and we've got crucial data points coming out that could tip the scales. So what are these big events we need to be watching? What's on the agenda for the Eurozone?
Well, for the euro, we've got a few things to keep an eye on.
Yep.
On Tuesday, March 18th, Germany is releasing its ZEW Economic Sentiment and Current Situation Reports.
Okay.
These reports give us a glimpse into how investors are feeling about the German economy.
Got it. So if those reports are positive, it could boost confidence in the euro.
Right.
But if they're negative, the euro could take a hit.
Exactly.
What else is happening in the Eurozone?
On Wednesday, March 19th, we'll get the Eurozone's CPI inflation data for February.
Okay.
It's always a big one.
Yeah.
Because if inflation remains high, it could make the European Central Bank, or ECB,
Right.
less likely to cut interest rates,
Mhm.
which would be good news for the euro.
Right.
But if inflation cools down more than expected, well, that could weaken the euro.
Makes sense. Inflation definitely plays a huge role in interest rate decisions.
It does.
Anything else we should be watching for in the Eurozone?
On Thursday, March 20th, ECB President Lagarde is speaking at a EU Parliament hearing.
Okay.
Her comments could have a major impact,
Okay.
depending on how she frames things.
Yeah.
Economists often describe central bank leaders as either hawkish or dovish.
Hold up. Hawkish versus dovish. Remind me what those terms mean in this context.
Sure, in central banking, hawkish generally means more concerned about inflation and less likely to cut interest rates.
Okay.
Dovish means more focused on economic growth and potentially more open to cutting rates.
Gotcha.
So if Lagarde sounds hawkish, it could signal that the ECB is in no rush to lower rates,
Okay.
which would support the euro.
Right.
But if she sounds more dovish, it could send the euro lower.
Okay. Thanks for the reminder.
Sure.
So a lot depends on what Lagarde says, and I'm sure analysts will be reading between the lines.
Oh, yeah, definitely.
What else is on the Eurozone calendar?
One more event to watch is on Friday, March 21st.
Okay.
We'll be getting the preliminary Eurozone consumer confidence data for March. Consumer confidence can be a powerful force
Yeah.
because if people are feeling good about the economy, they tend to spend more,
Right.
which boosts growth.
Right.
A positive reading here could signal that the Eurozone economy is on solid ground,
Okay.
which would be good news for the euro.
Okay, that makes sense.
Yeah,
So that's a lot going on in the Eurozone.
it is.
What about the U.S.? What's on the economic calendar this week that could impact the dollar?
Well, buckle up because the U.S. economic calendar is jam-packed this week.
Yeah.
We could be here for a while if we go through every single report, but let's focus on a few of the most important ones.
Okay, that sounds good. Let's hear it. Which reports are you watching most closely and why?
For the U.S., one of the big ones is the Federal Reserve's interest rate decision on Wednesday, March 19th.
Okay.
This is always a major market mover.
Yeah.
Right now, the target range for the federal funds rate is 4.25% to 4.50%.
Okay.
The question is, will they leave rates unchanged or signal any changes to their monetary policy?
Okay, so the whole world's going to be watching to see if the Fed hints at raising rates, cutting rates, or just staying the course. What are the experts predicting? Do they think the Fed is going to shake things up this time?
Most analysts believe the Fed will hold rates steady for now,
Okay.
but what's even more important is any guidance the Fed gives about future rate moves.
So reading between the lines is key here.
Yeah.
If the Fed sounds hawkish, meaning they're still worried about inflation and not in a hurry to cut rates that could strengthen the dollar, right?
Because investors will think the U.S. economy is strong enough to handle higher rates.
Exactly.
Okay.
But if the Fed signals a more dovish stance, suggesting they might ease up on monetary policy soon,
Right.
it could weaken the dollar.
Yeah.
Investors might start looking to other currencies with higher yields.
Got it. So Wednesday is going to be a nail-biter for anyone watching the dollar.
For sure.
It's all about the Fed's tone and what signals they send about future rate moves. But it's not just the official announcement we need to pay attention to, right? There's also Fed Chair Powell's press conference.
You're absolutely right.
Hmm.
Powell's press conference, also on Wednesday, is just as important as the rate decision itself. Analysts will be hanging on his every word,
Yeah.
looking for clues about the Fed's thinking on inflation, economic growth, and future interest rates.
It's like a high-stakes game of poker.
It is.
The Fed holds the cards and the market is trying to guess its hand. Speaking of trying to read the future, earlier we were talking about the euro's impressive climb. You mentioned that some experts are predicting a potential pullback. There's this report called Euro to Dollar Week Ahead Forecast, Lion's Share of Gains Complete. That caught my eye. It sounds like they're saying the euro's big run is over.
Well, technical analysis, which is what that report focuses on, is more about probabilities than certainties.
Okay.
They're basically saying that based on the charts and indicators, it looks like the euro might be due for a pullback or a period of consolidation. They're not saying further gains are impossible, but they think the easy money has probably already been made.
Okay, so maybe like a climber who's just scaled a steep mountain.
Right.
The euro needs a breather before trying for the next summit. What are the specific signals in the charts that suggest a pullback might be coming?
One thing they highlight is the euro's break above its 200-day moving average. This can signal a shift from a downward trend to an upward trend, but they also point out that the euro has become overbought in the short term, with the RSI exceeding 70, as we discussed earlier.
Right.
This could mean a correction is around the corner.
So it's like the euro crossed an important threshold, but then got a little ahead of itself in the excitement.
Right.
Makes sense that this could lead to a temporary pullback.
Exactly. They also noticed that the euro has already given back some of its recent gains after hitting that overbought condition. So, again, not a crash, but a step back from its recent highs.
If they're right and the euro does pull back, where do they think this pullback might end? Do they have any price levels in mind where they think buyers might step in?
They suggest that support might be building around the 1.0824 level. This level was tested 3 times last week, and each time buyers came in and prevented further declines. This indicates that there's buying interest at this level, which could act as a cushion.
Okay, so 1.0824 is a level to watch if the euro starts to slide. That's where we might see buyers step in to try and stop the bleeding. But what about the upside? If this pullback is just temporary and the euro resumes its climb, where do they see it potentially heading next?
Their upside target for the week ahead is 1.0946, which is the 2025 high.
Okay.
It's a logical target because it represents a previous resistance level that the euro has now broken through. If the euro can regain momentum, it could make another run at this level.
Okay, so we've got potential support at 1.0824 and potential resistance at 1.0946. This gives us a good framework to watch how things play out in the coming days. But let's zoom out and look at the big picture for a minute. This analysis piece you mentioned highlights a key theme that's been driving the euro's recent strength, the fading of the U.S. exceptionalism narrative. Can you talk more about that? What does it mean, and why is it so important for the euro-dollar exchange rate?
Remember, currency markets are driven by expectations and perceptions as much as by economic data. The U.S. exceptionalism narrative is basically the idea that the U.S. economy is inherently stronger and more resilient than others. This perception has supported the dollar for years, making it the go-to currency for investors seeking safety and stability. But this narrative is starting to show cracks, and that's creating opportunities for other currencies like the euro.
It's like the U.S. is losing its star power and the euro is ready to step into the spotlight. But what's causing this shift in perception? Is it just about Germany's spending plans, or are there other factors involved?
Germany's spending plans are definitely part of it because they signal that Europe might finally be addressing its economic challenges. But there are other factors contributing to this shift away from U.S. exceptionalism. One is the policy uncertainty coming from the White House. It's created an environment of unpredictability that's making some investors nervous.
Yeah, the whole what will happen next feeling not exactly reassuring for investors.
Exactly. And then there's the ongoing trade war and the threat of more tariffs. A lot of analysts think the tariffs are hurting the U.S. economy because they raise prices for consumers and businesses and create uncertainty for companies that rely on global supply chains.
So it's a combination of things: policy uncertainty, trade war anxieties, and the feeling that maybe the U.S. economy isn't as invincible as some people thought.
Right.
This creates a more level playing field for the euro, which helps explain its recent strength. But we can't forget about the potential headwinds we talked about earlier, like the possibility that Germany might have trouble spending all that money, or that the U.S. could escalate the trade war.
Absolutely. Those risks are still very real, and it's important to factor them in. Another thing that the report mentions is the potential for a more sober assessment of the outlook to emerge. This could also weigh on the euro.
What do they mean by a more sober assessment? What would cause that to happen, and how could it affect the euro?
I think what they're getting at is that there's a risk of the market getting a little carried away with the positive news from Europe, especially Germany's spending plans. The initial euphoria might fade as investors start to think about the practicalities of implementing those plans. Remember, Germany has a history of struggling to spend allocated funds, and there's a chance that this time won't be different.
So it's a bit of a buy the rumor, sell the news scenario.
Yeah,
The market gets excited about the potential, but then reality sets in and the initial optimism starts to wane.
it's exactly. This potential shift in sentiment is something Davide Oneglia, an analyst at TS Lombard, pointed out when talking about the 100 billion special fund for the German army. He said that the recent experience shows that permitting new projects is a lengthy process in Germany. In other words, even if the money is there, actually spending it quickly and efficiently might be a challenge.
It sounds like the wheels of government can turn pretty slowly even when there's a desire to spend money.
They can.
So even if Germany is serious about increasing spending, the actual impact on the economy might take longer than expected, and that could dampen some of the excitement that's been pushing the euro higher.
That's right. And it's not just outside analysts who are raising this concern, as we mentioned earlier. Analysts at Commerzbank, a major German bank, are also predicting a potential sharp fall for the euro as the initial enthusiasm over Germany's spending plans fades. They don't think the stimulus will have a real impact until next year, and they're skeptical about Germany's ability to overcome its spending challenges.
So we have some serious players within Germany sounding the alarm bells, too.
We do.
This more sober assessment could definitely become a headwind for the euro if the market starts to doubt Germany's ability to deliver.
Right. And then there's the threat of U.S. tariffs,
Hmm.
which, as we discussed, could push Germany back into recession.
Right.
It's a delicate situation, and the euro's fate really depends on how all these different forces play out.
Okay, so the big picture is definitely something to watch closely. Now, let's dive into the specifics of the economic calendar for the week ahead. You mentioned earlier that there are a lot of key data points coming out that could move the needle for both currencies. Let's start with the Eurozone. On Tuesday, March 18th, we have the ZEW economic sentiment and current situation reports for Germany. These reports are a big deal because they give us a sense of how optimistic or pessimistic German businesses are feeling about the economy.
Yes, they are closely watched indicators for the ZEW Economic Sentiment Index. The expectation is for a reading of 50.0, which would be a big jump from the previous reading of 26.0. This tells us that analysts are expecting a significant improvement in sentiment among German businesses.
A jump from 26.0 to 50.0 would be pretty impressive. That would definitely be a good sign for the German economy.
What about the EEW Current Situation Index? What's the outlook there?
For the current situation index, the expectation is for reading of NH 80.5, which is slightly better than the previous reading of NH 80.5. It still indicates that businesses are feeling pessimistic about the current state of the economy, but it does suggest that things might be stabilizing.
Okay, so the sentiment is expected to improve, but the current situation is still tough, although maybe not as bad as before. It's a mixed bag, but overall, it seems like the ZEW reports could give the euro a boost, especially if that sentiment reading comes in strong.
I agree. Now, on Wednesday, March 19th, we have the final reading of Eurozone CPI inflation for February, as we discussed earlier. Inflation is a major factor for the European Central Bank. A high inflation reading could mean they're less likely to cut interest rates, which would be good for the euro.
Right, so what's the forecast for inflation? The final reading is expected to confirm the preliminary estimates of 0.5% month-over-month and 2.4% year-over-year. This means that inflation is still high in the Eurozone, which could give the ECB some flexibility with monetary policy.
If inflation stays high, the ECB might not feel as much pressure to cut rates, and that would support the euro. But if the inflation reading is weaker than expected, it could raise concerns about deflation and increase the chances of rate cuts, which would hurt the euro.
Exactly. It's all about how inflation plays out. Moving on to Thursday, March 20th. We have two important events for the Eurozone. First, ECB President Lagarde is speaking at an EU Parliament. Hearing her comments could have a big impact on the euro, depending on whether she leans hawkish or dovish.
Right, we talked about that earlier. If Lagarde seems worried about inflation and indicates that the ECB isn't planning to cut rates anytime soon, that could boost the euro. But if she emphasizes economic risks and hints at possible rate cuts, the euro could weaken. Everyone will be listening very carefully to what she says.
Absolutely. The second event on Thursday is the preliminary reading of Eurozone consumer confidence for March. Consumer confidence is a key driver of economic growth, and a strong reading could suggest that the Eurozone economy is on more solid ground, which would be positive for the euro.
So a good consumer confidence reading could mean more spending and stronger growth. What are the expectations for this report?
The preliminary reading is expected to come in at a NAJS 13.2, which is slightly better than the previous reading of NAJS 13.6. Consumer confidence is still weak, but it might be starting to stabilize.
Any sign of stabilization is good news at this point. Okay, let's shift gears and talk about the U.S. economic calendar. We mentioned earlier that it's a busy week with a lot of important data releases, plus the Fed's rate decision and press conference. Let's start with Monday, March 17th. We have the retail sales advance report for February and the Empire Manufacturing Index for March.
The retail sales report is all about consumer spending, which is a major driver of the U.S. economy. The forecast is for a 0.7% increase in retail sales for February, which would be a nice rebound after the 0.9% decline in January. Strong retail sales would be a positive sign for the dollar.
Right, strong consumer spending would suggest that the U.S. economy is still in good shape. What about the Empire Manufacturing Index? What are the expectations there?
The expectation is for a reading of negative 2.0 for the Empire Manufacturing Index for March, which would be a significant drop from the previous reading of 5.7. This suggests that analysts are expecting a weakening in manufacturing activity in the New York region.
That's a bit worrying. A negative reading on the Empire Manufacturing Index could signal a broader slowdown in U.S. manufacturing, which could hurt the dollar.
Yes, but we should remember that the Empire Manufacturing Index can be volatile. We'll need to see how other manufacturing data plays out to get a clearer picture.
Okay, so Monday's data might give us mixed signals about the U.S. economy, potentially strong retail sales, but also a possible dip in manufacturing. What about Tuesday, March 18th?
On Tuesday, we have the Industrial Production Report for February. This report covers manufacturing, mining, and utilities output, so it gives us a more comprehensive view of industrial activity than the Empire Manufacturing Index.
What are the expectations for this report?
Analysts are forecasting a 0.2% increase in industrial production for February, which would be slower than the 0.5% increase in January if industrial production comes in weaker than expected. It could raise concerns about a U.S. economic slowdown and potentially weigh on the dollar.
So Tuesday's data might reinforce the concerns about a potential manufacturing slowdown that we saw in the Empire Manufacturing Index. Definitely something to keep an eye on. But of course, the big event of the week is the Federal Reserve's interest rate decision and press conference on Wednesday, March 19th. As we've been discussing, the Fed's every word will be analyzed for clues about the future direction of monetary policy.
Absolutely. The FOMC is expected to leave interest rates unchanged at its meeting this week. But what will be more important is any guidance they provide about future rate moves if the Fed sounds hawkish, suggesting that inflation is still a concern and they're not planning to cut rates anytime soon. It could strengthen the dollar.
Right, because it would signal that the U.S. economy is still strong enough to handle higher interest rates. But what if the Fed sounds more dovish, hinting that they might ease monetary policy in the near future?
A dovish shift could weaken the dollar, as investors would anticipate lower interest rates down the road, making the dollar less appealing compared to currencies with higher yields.
So the Fed's tone is going to be key. And of course, Fed Chair Powell's press conference is just as important as the rate decision itself. Investors will be listening for any hints about what the Fed is thinking on inflation, economic growth, and interest rates.
Exactly. If Powell emphasizes inflation risks and downplays the need for rate cuts, it could boost the dollar. But if he focuses on economic risks and suggests that rate cuts are a possibility, it could put downward pressure on the dollar. Trying to decipher the Fed's message is a big part of what drives currency markets.
It's going to be a fascinating day for currency traders. Now, moving on to Thursday, March 20th, we have two more U.S. economic reports to cover: the initial jobless claims report for the week of March 15th and the Philadelphia Fed Business Outlook report for March.
The initial jobless claims report gives us a weekly snapshot of the U.S. labor market. The forecast is for 225,000 initial jobless claims for the week of March 15th, slightly higher than the previous week's reading of 220,000.
So a slight increase in jobless claims is expected, as we mentioned earlier. A higher than expected number could raise concerns about the labor market weakening and increase the chances of a rate cut from the Fed, which could weigh on the dollar.
But if jobless claims come in lower than expected, it would support the idea that the labor market is still strong, which would be good news for the dollar.
Okay, so another data point to watch closely. And finally, what about the Philadelphia Fed Business Outlook report? What are analysts expecting?
The expectation is for a reading of 10.0 for the Philadelphia Fed Business Outlook report for March, significantly lower than the previous reading of 18.1. This suggests that business confidence in the Philadelphia region might be declining.
Another potential sign of weakness in the U.S. economy. If business confidence is fading, it could signal slowing growth, which would likely put downward pressure on the dollar.
That's right. But like the Empire Manufacturing Index, the Philadelphia Fed Business Outlook report can be volatile, so we need to see how other business confidence data points look to get the full picture.
Okay, so Thursday's data could add to the concerns about a U.S. economic slowdown. This is shaping up to be a week full of uncertainty for both the euro and the dollar.
Absolutely. And it's a good reminder that currency markets are constantly changing, driven by a mix of economic data, geopolitical events, and market sentiment to navigate this complex landscape. It's important to stay informed and pay attention to both the big picture trends and the smaller details.
I couldn't agree more. So before we wrap things up, let's zoom out one last time and talk about the key takeaways from our euro versus dollar deep dive. The euro has been on a hot streak lately, reaching multi-month highs, but there are signs that this upward momentum might be slowing down. We've got technical indicators suggesting that the euro might be overbought, and some analysts are even predicting a potential pullback. It's a classic what goes up must come down situation, right?
That's one way to look at it. Yeah, and remember, Germany's ambitious spending plans, while exciting, come with some big questions.
Yeah.
Can they actually overcome their history of slow spending and make this work? And what happens if those U.S. tariffs come into play? There's definitely a lot of uncertainty in the air.
Right. Germany's spending plan is like a double-edged sword. There's potential for growth, but there are also some serious risks if they can't execute or if those tariffs hit on the U.S. side. We've got a mixed bag as well. Consumer spending seems to be holding up. But there are signs of weakness in manufacturing. And of course, the big wild card this week is the Federal Reserve. Everyone is on the edge of their seats waiting to see what they'll do with interest rates and what kind of signals they'll send about the future.
It's going to be a week full of suspense. And as we've said throughout this deep dive, it's not just about looking at the economic numbers. It's about understanding the narratives surrounding these currencies and how those narratives impact market sentiment.
I think that's a really important point. The euro and the dollar aren't just pieces on a chessboard. They represent these big, complex stories about global power and economic shifts, and those stories are always evolving.
You've hit the nail on the head. It's like watching a drama unfold in real time with economic data and geopolitical events shaping the plot.
Exactly. And speaking of stories, there's one final piece I wanted to bring up. We've talked a lot about the economic and geopolitical factors that are driving these currencies, but there's another element that's always at play: psychology.
Right, the human element. Fear and greed play a huge role in the markets.
Think about it this way. Currency markets are ultimately driven by the decisions of millions of people around the world. And those decisions are often influenced by emotions as much as logic or data.
That's absolutely true.
Yeah.
Sometimes a piece of news can trigger a wave of fear or euphoria in the market, and that can move prices in ways that wouldn't make sense based purely on the numbers.
Exactly. So as we watch the euro and the dollar dance this week, let's keep that human element in mind. Are traders reacting to the news with fear, excitement, or maybe a mix of both? Because understanding the psychology of the market can sometimes be just as important as understanding the economics.
I couldn't agree more. Sometimes the key to understanding market movements lies in deciphering the collective mood of the crowd. It's fascinating, isn't it? How these currencies are influenced by so many factors, both tangible and intangible.
It really is. It's like trying to solve a puzzle where the pieces are constantly changing shape. But that's also what makes it so engaging. There's always something new to learn, always a new twist in the story.
I think that's a great note to end on. It's a reminder that the world of currency markets is dynamic and complex, and that's what makes it so captivating.
Well said. And on that note, we'll wrap up our euro versus dollar deep dive. We hope you've enjoyed this journey into the world of currency markets. Remember, it's not just about watching the numbers. It's about understanding the forces, both economic and psychological, that are driving those numbers. Keep exploring, keep learning, and until next time, stay curious.